So on Friday, the government seized a bank? Yep, that's what everybody's talking about. It's the second biggest banking collapse in history. What happened? SVB became the bank for startups in Silicon Valley, and by the end of March 2021, they had $124 billion in deposits. That's a lot of billions. When cash flow was good and interest rates were low, they made a lot of risky investments, bought a lot of bonds, threw luxurious parties, and by the end of 2022, they reported $15 billion in losses. That's a big L. The Fed raising rates made it more difficult for startups to borrow or raise money. So they started withdrawing from SVB. Yikes. So finally, SVB was short on funds and at risk of a credit downgrade. What is that? That basically means it's a risky investment to put your money into. Okay. So on Wednesday, they decided to sell $21 billion of bonds at a $1.8 billion loss. They announced that they were going to sell $2.25 billion in shares to cover the loss. Damn. People heard about it and withdrew $42 billion from SVB on Thursday. I mean, I would too if I heard that about my bank.
Well, damn, as we heard, Silicon Valley Bank over the weekend, as everyone was talking about, then had their issues. And now we're wondering what's next, because we saw some of the irresponsible things that Burbank was talking about there in her video, but she wasn't done yet. There's more, in case you guys haven't figured everything that's going down.
SVB stock dropped about 60% and another 30% after the market closed. It's just L after L after L. By the end of the day, SVB was in the negative $948 million. Now, there's insurance covering up to $250,000 in deposits, but these are Silicon Valley startups. They had a lot more money in their accounts. And it turns out reports show only 93% of the money in SVB was insured. Another big L for SVB. Basically, this bank took a bunch of people's money, irresponsibly gambled with it to make more money off of it, and then when people asked for their money back, they couldn't give it to them. What happened to the people who had money in this bank? Etsy has actually had to delay payments to sellers, and stablecoin had about $3.3 billion linked to SVB, so this could crash the crypto market as well. So there's going to be real consequences for people even outside of Silicon Valley. Well, the FDIC seized the bank, so now they're going to try and sell their assets and make payments to the uninsured deposits. It sounds like this should be illegal. The craziest part is the CEO, Greg Pecker, sold $3.6 million of his personal shares before disclosing the losses. That's like cashing your chips in while you're bluffing. Casinos might have more rules than the banks do.
Absolutely. And by the way, one small thing, 93% of the uninsured there as far as their assets throughout the banks. Burbank, of course, fixed the record on that. And again, some of these lack of regulations, how can these bankers, these folks that are in charge of this, pull all these stunts right before they finally spring it on everyone else after these risky investments with other folks' money based off of all these other things? Who is going to control these folks? They're not the huge banks. They're just very, very large banks that we decide to call not huge banks, going through all of this back and forth. Who is it? Someone that could, like, maybe there's a regulation in place. Hopefully something was done to stop this before it happened, considering we had issues before. It's crazy. It's like someone would have to come in and loosen those regulations. Let's look back.
The legislation I'm signing today rolls back the crippling Dodd-Frank regulations that are crushing community banks and credit unions nationwide. They were in such trouble. One size fits all. Those rules just don't work. And community banks and credit unions should be regulated the same way, but they shouldn't be regulated the same way as the large, complex financial institutions. And that's what happened. And they were being put out of business one by one. And they weren't lending. Since its passage in 2010, Dodd-Frank has dealt a huge blow to community banking. No president, whether it's 4 years, 8 years, or 16 years in one case, has ever passed more regulation cuts.
Luckily, you guys, Jessica Burbank is here to speak about everything she was breaking down, and also this intersection when it comes to one administration coming in and loosening some regulations and the details that went around that. If everyone actually paid attention and knew exactly how this worked, and I get the complicated nature of it, because there's aspects of it I don't get either, then we would understand how these things keep happening and who it is that keeps doing it. And no, it's not just Republicans. Burbank, what's your thoughts?
Yeah, it's not that we haven't learned our lesson with how banks collapse. We know how banks collapse, right? A bank is supposed to hold our money for us. And they're not required to keep all of the cash on hand that people deposit. It's called fractional reserve banking. It's super common at every single bank. The problem is a lot of these banks will invest in risky things. Silicon Valley Bank was known for operating kind of like a market fund rather than a bank with what they were investing in. And they're also not stress testing for potential like future macroeconomic conditions like we're experiencing right now where interest rates are high. And so that was a part of this regulation was these banks would have to stress test for conditions like the ones we're experiencing today once they achieved the threshold of 50 billion in deposits. Now this bank, Silicon Valley Bank, that was shut down and seized on Friday, as we know, had over 124 billion in deposits. Then there's another bank that was closed yesterday, Signature Bank of New York, that had 88 billion in deposits. So that would have hit the 50 billion threshold. That was a part of the Dodd-Frank regulations after the 2008 financial crisis. Silicon Valley Bank and many other banks, which are not small community banks, these are pretty large, they lobbied against that regulation. So now that the stress tests are at 250 billion, thanks to the repeal in 2018, and it was bipartisan. There are some Democrats that voted for it. It was led by McCarthy. Of course, Trump signed the bill, but this could have been prevented. This regulation would have prevented these people from basically gambling with folks' money. So they didn't have cash on hand when people were trying to withdraw from the bank. They weren't doing a good job managing the money. As we know, they had a lot of losses. So really, yeah, the regulation being repealed is a problem, but also these were people just irresponsibly running a bank.
People irresponsibly running a bank. People showed up and wanted their money and it wasn't there. Where did it go? It went to other interests. It went to people who have the control over your money, whoever was involved in this, to whatever the hell they wanted, because they were making more money off of your money in risky ways, extraordinarily risky ways. And again, Burbank went through all that, talked about how these banks lobbied to raise that threshold from the 50 billion to what? 150 was it, Burbank?
250
to $250 billion. And we're still calling them small community banks. And again, if you guys don't know what lobbying is, it's using their money to tell politicians to do their bidding so they can make more money without any other kinds of regulations. Hey, lessen how much that you're gonna be watching us by us paying you to do so. It's like a mobster paying off the cops so they can allow them to continue to run rampant on the community. Does that sound like something that you're in favor of? Because it keeps happening. Again, as you pointed out, Burbank, this is not uncommon. So of course, as I mentioned to you, I wondered what's President Biden gonna say about this and what is he gonna do? Here we go.
On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured, they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund.
Does this make much sense to you, Burbank? Again, the protection of the customers with the money, but then this is not a bailout of the banks, he says. This is a bailout of the customers. Will it also maybe help some of these banks though?
Right, yeah. I mean, it's not helping the banks considering they've been seized. It would be a really big problem if there was some kind of reversal and they came to an agreement and they let the same senior management take over these banks again once they sorted the situation out. But what they've done is they've seized the banks and their assets. So what they're going to be able to do is take all of those investments that the bank had and liquidate them. So sell them, turn them into cash to cover the deposit. So they'll temporarily take the money out of the FDIC. It is not coming from American taxpayers, that's good. It is coming directly from the FDIC. They have a fund that will allow them to insure deposits. Of course, people are worried. What if everybody freaks out and everybody, tries to withdraw their money? The Fed has a contingency plan for that. We don't really see that happening, a Great Depression style bank run. But basically, they're able to protect people's deposits. They're not bailing out the shareholders or people who had stock in these banks trying to make money off of other people's money, which is a good and just move.
Next step is what's going to keep this from happening yet again with another small community bank that is lobbying our legislators to raise things up to $250 billion. Yes, these are the type of banks that put their names on stadiums and all that type of stuff. That's still small enough, by the way.